trying to explain the divergence between the market being so calm and it's currently sitting at all-time highs as we're speaking, and consumer sentiment effectively being near or at all-time lows. It's very confusing, and our job is sometimes to figure out what's going on and explain that in a way that's understandable, and it's very difficult right now. I think there are people that are trying to do it and, in my opinion, failing, because we're in a situation where some of this cannot necessarily be explained. There's complacency about a situation in the Middle East that is, honestly, it's a very big deal. There's an enormous disruption to global energy markets right now. And there's a narrative that the US is energy independent. We're a net oil exporter, which is actually not true. There's a major disruption in global energy markets, and I think there is the window for a solution to happen that somehow brings the supplies and production back to where they were before this conflict started is closing fairly quickly, and the market seems to be kind of whistling past the graveyard. It's confusing, and my opinion is that anybody that is claiming it's not confusing or that everything is making perfect sense is maybe a little bit in the weeds right now. We had a spike down in markets as the conflict began, and then quite literally there was a tweet that has since been disproven that there's going to be some sort of negotiations and resolution forthcoming, and the market reversed on a dime and backed straight to all-time highs without basically taking a breath. And I have to believe that there's some sort of programmatic buying and selling programs happening with institutional money managers that are being caught off sides week after week, and that is currently driving things more than fundamentals. So a long-winded explanation of why there is such a gap between how people feel, consumers and investors, and where the market is. I'm willing to just say it's a little confusing. Obviously, we would prefer that the market be up and at all-time highs and have things be confusing than things going the other direction. But I think caution is very much warranted, despite the fact that it's been one-way traffic for the last week and a half. Is there a misunderstanding about the US's standing in the global oil markets? It's a fun thing to say and to believe that the US is energy independent, but it's not correct. We are the world's largest producer of crude oil today, with roughly 13.5 million barrels of oil per day, which is more than Saudi Arabia. That is something that's changed over the last 10 years. And there are benefits to the US of that being the case. However, I don't think it's at all fair to say that we shouldn't be worried about what's happening in the Middle East because we produce more oil than anybody else, for a couple different reasons. One, there's different types of oil, and what the US produces is different than what we get from the Middle East, and inputs to make gasoline and jet fuel and other petroleum products vary a great deal. So we cannot exist on our own with the 13.5 million barrels that of the type of crude oil that the US produces. So that being said, there are benefits to the US, not necessarily to US consumers, but to the US as an economy, of being the world's largest oil producer and having oil prices be elevated. So of course, the big oil companies are able to make more money when they're selling a product that they're taking out of the ground for roughly the same cost as it was a year ago, and they can sell it for a higher price today. That's a benefit to US oil companies. That being said, if the disruption in the Middle East continues and oil prices stay elevated, or even were to go up another 50 or 100% from where they are globally, that would end up being a real problem for other parts of the U.S. economy. For instance, consumers. The expense of driving and transportation would go up. The input costs for all sorts of things that we buy, our companies make, they use petroleum to make certain anything that's made out of plastic. A lot of clothing companies use a lot of petroleum. Not to mention the cost of getting goods from A to B. So inflation is something to really keep a close eye on, and we haven't seen it hit the data points just yet. But like I said in the first question, you know, the window is closing pretty quickly for this to end up being a non-issue. Is the Mag 7 trade over? No, I think is the easiest answer. No, it's not over, but it's definitely evolving. You know, the Mag 7 as a collective were up 40% in 2021, down 40% in 2022, up almost 80% in 2023, up almost 50% in 2024, and then up about 20% last year, 2025, and thus far in 2026, down double digits. So it's interesting, like the absolute performance has kind of been going down a little bit, and then also the relative performance to the S&P, let's just use the S&P, has also been going down. It's now negative. Does that mean that the trade is over? No, I think most of those 7 companies are must-owns. These are enormous parts of our daily lives and of the U.S. economy, the world economy. I think you got to own these stocks. Does that mean they're going to outperform the S&P every year? Certainly not. And like we saw in 2022, where we had a rate spike due to inflation concerns, and those companies all just went on sale. So it's possible that we're having a little bit of a redux of 2022 now, where those companies are floundering for whatever reason. And I think what's happening is investors are a little bit eager now to see some tangible results from the investments that these companies have made in this AI race. And at this point, we're talking about trillions of dollars, or over $1 trillion. Each of these Mag 7 companies has invested hundreds of billions of dollars each in the AI race. So, which is great. I think it's something that has kept people excited and engaged about what's coming next for these companies. But at this point, it's been a lot of capex and not a lot of return. So it's possible that that's going to be the narrative about why these companies are lagging a little bit this year. But the good news is, you know, this is something that we talked about 6 months ago or so, maybe September or October of last year, as a possible theme for 2026, which is just a changing of the guard and the baton being handed from these Mag 7 companies to the other 493 companies in the S&P 500. And obviously, that's not quite literally the case, but we are seeing certain sectors that are picking up the slack. You know, the S&P is positive this year, despite Mag 7 being down double digits. And we're seeing performance from areas that are generally boring, like we all know energy is up, consumer staples, utilities, materials. These are sectors and areas of the economy that are starting to pick up a little speed. And I think they're catching a little bit of the AI investment. So the money that is being invested in this AI build out for the largest companies in the world is being invested in some of the areas that had been lagging. So we're seeing a broadening out of the market, which generally speaking is what you want to see. So sentiment's bad, but we're getting kind of, you know, what if you're bullish, you're kind of getting what you want. The companies that are spending the most on AI are the growth companies, and they're not seeing any tangible ROI yet, but that money is going somewhere. And I think it is the recipients are the companies that are not necessarily making borrowing money to invest in AI, but they're actually responsible for some of the build out, you know, the utilities, which are really just shipping energy and electricity from A to B and storage of energy. So it is interesting to think that the value stocks are benefiting more in the short term than the growth stocks from this AI race. First of all, we're going to talk a little bit about the strength in the international and emerging markets versus the U.S. over the last year or so, and then maybe talk about whether or not that's sustainable. So it's just true that last year, 2025, was the first year that we saw meaningful outperformance from areas like Europe and Asia versus the United States and emerging markets as well. And we're seeing a continuation of that this year. It's a little counterintuitive because last year was the year that we instituted tariffs on all of these places. So in theory, there should have been more pressure on their economies, but they have responded. And I think what's happened is these foreign governments are pumping money into their system. They're spending money, they're borrowing money, and they're spending money on things like defense and just stimulus for their economies, and it's helping their stock markets. So is it sustainable this year? I meant to touch on also currencies. You know, the dollar had been strong versus foreign currencies for 15 years in a row. And what we saw last year was the first year where the dollar actually weakened meaningfully against things like the euro and the yen. So that's super helpful for their economies, or their markets at least, for sure. And that has continued a little bit this year to a lesser extent. What I'm worried about, especially when it comes to Europe, is the energy crisis that we discussed in the first couple of questions, because that is going to affect them, assuming it doesn't get resolved. It's going to affect them significantly more than it is the United States, because they produce barely any oil. So they're a net importer. Virtually 100% of what their energy consumption comes from outside of Europe. So high prices when it comes to oil, petroleum products, gasoline, jet fuel is going to have a major effect potentially on Europe. So I would just really be careful with following that piece of news. So just to bank on continued outperformance of international versus US, I think there's a huge caveat, which is that the situation in the Middle East gets resolved somewhat soon and in a fashion that returns global energy markets to some semblance of normal or what things looked like before the war started. We end every video with the segment of what could go right, because there's just a torrent of negative news out there, and so sometimes it's a little bit of a project to come up with what could go right. And right now, I can't remember ever doing one of these videos where the market is at or near all-time highs, sentiment is so bad. You know, what could go right? As far as the market is concerned, it's almost like everything is going right. You know, corporate profits are high and expected to improve this year by 18%, and the market's just doing just fine. We're shrugging off what feels like a real market negative event. What's happening with the uncertainty in the Middle East? I mean, nobody knows how it's going to end. Nobody knows if it's going to end anytime soon, and it has very real impacts on input costs for just about everything, with oil being up 50% over where it was 2 months ago. So what could go right is certainly some resolution over there. And I think consumer sentiment is bad for a couple different reasons. I think there is this sort of chaotic uncertainty coming out of the administration. I think people just don't feel confident that policy is going to be consistent and something that they can count on, because things do seem to change on a tweet. So that it makes sense that people would be a little bit on edge with that sort of messaging being in control. Costs are going up. You know, inflation isn't off the charts, but it is still too high. So costs are going up. There's been very little movement in terms of housing affordability. So people that are looking to get into their first house or upgrade, it's very challenging right now. The labor market is strong, but people aren't feeling super confident about their prospects if they were to change jobs or ask for a raise. And I think AI is sort of playing into that. I think that has people in a lot of different industries are nervous because they just don't know this fast-moving thing that is supposedly coming for all of our jobs. It's out there, and I think there's nervousness, which makes sense. And the market so far is not really responding. So what could go right is, I think, just some more consistent messaging from the current administration. Something pointing us in the right direction in terms of the conflict in the Middle East, and maybe some data points that give the Fed permission to at least signal that further rate cuts may be on the way, or at least we don't need to be worried about interest rate hikes. So there's a few things that could go right. I don't think there's too many of those that are going to get answered between now and the next video. So it's a good time for investors to sit on their hands a bit and try to avoid making major decisions, major mistakes for your portfolio.